How you guys doing? We're gonna go over the FOMC minutes today. Today is FOMC, which is basically these statements from the Federal Reserve as a group about the last Fed meeting. Their outlook on the economy, their outlook on rates going forward, and the market is trying to price in rate cuts. The market is looking for, when are you going to cut rates? When are you going to ease financial conditions? Because financial conditions are tight, right? Just so you know, on the charts I have the charts up here, the dollar, because I want to see how the dollar responds. Right now, the dollar is pressing the upper limit of the trend. If it breaks out, it's going to crush assets. We call the dollar the wrecking ball, because when it does move extremely to the upside, it usually causes a lot of havoc. It's a domino effect. Now, taking a look over here on the right-hand side, you got TNX, 10-year Treasury yield, right? The cost of capital, which is the biggest risk to the market right now. If you got the newsletter, you'd see that the whole downgrade from Fitch, the whole downgrade for JP Morgan, all these other banks that are getting downgraded on their debt, it's basically the cost of capital is going higher. You see TNX, which is just the TOS, it's really 10-year Treasury yields going higher, the yields going up. But the real mess here is that when yields go up, the collateral is going down at the same time. So what we're really seeing is collateral collapse, and the collateral is what funds everything, right? If you're on margin, if you're borrowing, whatever it is, you're borrowing a house. If you're not borrowing a house, if you're borrowing, obviously you have a mortgage, you're borrowing from the bank. The house is the collateral. If your house collapses, if there is no collateral, you can't really borrow against your house. So that's how the financial markets work. The bond market's important. And as long as this goes up, and that's why we're looking for the reaction to ease financial conditions, we want to see TNX fall. And I think we're getting near that time. Hold on. I think we're getting near the FOMC release. We're going to listen to that release, and then we will, here we go. Let me see if they're ready now. We're a couple of minutes away. I'm going to switch the charts on YouTube over to. Yeah, I'm going to switch it over. We're going to listen to CNBC talk about the Fed minutes. And what we're really. Oh, no, I don't want to rewind that. What we're listening to is the language of the Fed changing their statements. They actually changed the statement in the last Fed meeting. I'm sorry, the last FOMC minutes. They removed further restrictive territory, but hey, did that really matter? No, because they actually hiked again. What up, Slime Z? So that's what we're looking for, is the change in the FOMC minutes. We're going to see how markets react to that, and we're going to look at a couple, what are the biggest market risks? The biggest market risks are yields. Okay, here they come. So we're going to be a little delayed here. I want to make sure that everybody can hear. All right, I'm going to switch this on YouTube over to. There we go. You guys should be able to see that. Let's make it a little bigger. I want you guys to be able to hear the FOMC minutes. And we're probably going to get a lot of tweets too, so we'll go over those tweets and just try to dissect the language on the FOMC. That's what we're trying to do here. All right, here we go.
Courtney, the minutes from the Fed's most recent meeting show that the most of the participants in the meeting still saw significant upside risk to inflation that could require further tightening. So at least in that one statement there, a pretty hawkish outlook there from the Federal Reserve. But hold on before you make your immediate trades, because these minutes are a mishmash of different points of view. Some of the top line comments, some saw downside risk to the economy and upside risk to unemployment. So that kind of sort of works against that, but it's a smaller number than the most who were concerned about the upside risk. A number said risks were two-sided, and we learned for the first time in these minutes that a couple participants, apparently not voters, just people who were at the table there among the bank presidents, wanted to keep the rates unchanged. So they were not in favor of, they were not voters apparently, or if they were, they didn't vote. They didn't vote what they said their concern was, and wanted to keep rates unchanged. Now,
so with that, so real quick, there's a couple Fed members who want to keep the pause. Basically, is what he's saying. Who want to keep the rate hikes from going even further, which would be in September, right? The September meeting. There is no meeting here in August. There's no meeting. So this is all about future expectations of what the Fed's going to do. And we know there's a couple members who are advocating for a pause to hold rates, especially with this banking risks. And this is before the banking risk. Now that we're starting to get all these downgrades and debt from the the commercial banks and some of the too big to fail banks, since we're starting to see that, I bet the pause is going to be further onto the table, right? I know we have a strong economy. GDP got revised up again, but there's a lot of reason for the Fed to pause here, and we're going to listen more. Also, we have, let's see, breaking news. This is the Twitter. I'm just want to listen to this also at the same time. Fed minutes. Most participants saw continued significant upside risk to inflation. Of course, we know that because it's not over yet. Oil prices, biggest risk. We see that it's getting rejected at 83.50, which is good news so far. Fed minutes. The banking system is sound and resilient. Tighter credit conditions likely to weigh on economy, and that tighter credit conditions is literally, quite literally, the bond market falling apart. Your collateral is coming down. There's less credit in the system, right? You can't lend as much because your collateral is down. Therefore, you tighten the system. There needs to be a buyer in the U.S. Treasury. There needs to be a big buyer in the U.S. Treasury market to stabilize rates and to stabilize the a lot of this stuff is coming out really quick now. Anyways, to stabilize basically the banking risk, right? You need somebody to come in and step in and to buy those treasuries so the collateral doesn't fall. It's all about collateral staying sticky. So we'll listen a little further. Then we'll go over the breaking news afterwards.
Now, I'm going to give you some positive comments, and I'm going to offset those with negative or hawkish comments. On the positive, dovish side, some saw tentative signs inflation could be abating, including softening core goods prices. There were continuing signs of supply and demand in labor coming into better balance. Tighter financial conditions were expected to slow consumption, and a gradual slowing appeared to be in progress in the economy. That was back when they met in July. However, that has not been the case. So here are some of the negative hawkish comments that were there.
So the positive is inflation is coming down in the goods sector, which is why manufacturing is kind of weak. We've seen that. We know that. So inflation is abating in some areas. The core is still a little bit sticky. There's the positives and there's negatives. He's reading the positives, and that's not even weighing on the economy. So that's the other positive. Labor market's still strong. Goods inflation is down. That is, 30% of the economy versus services. Services are kind of holding up that inflation. Here's the negatives.
They said real GDP had demonstrated resilience. That's been the case over the intermediate period here, and the economy showing considerable momentum. Again, that's been the case. This group saw payroll and wage growth that's still high, and several said significant disinflation had to become apparent in core services ex-housing for the Fed to relax on the idea of raising rates in the future. There was a high degree of uncertainty over the effects of past hikes. And one other thing I want to leave you with is this notion here that says that below trend growth is needed to bring supply in line with demand. We have not, Tyler, as you know from our discussion just an hour ago, had at least forecasts here for below trend growth. So that group in the Fed not getting what they want in terms of below trend growth.
All right, Steve, thank you very much.
Okay, well, we'll go over the rest. So one of the focuses that they did mention there is core services ex shelter. What that is you take out energy, you remove food inflation. Okay, this is what they want to focus on. You take out energy, you remove food, and you also take out shelter. Okay, you also take out shelter, which is rents, housing prices, owner's equivalent rent. And that's what they want to focus on. And hey, we saw that the quarter, the month-on-month reading was actually really good going forward. I don't know if he's going to keep speaking there. I might just let it run. But let's read some of the breaking news and some of the Twitter. There's a lot of stuff on Twitter. There's so much data out here, so let's interpret some of it, okay? And again, if their focus is on X energy, X shelter, X food, well, that is actually starting to come down on a year-over-year basis. That's progress. We should see that collapse into the twos pretty quickly here. Some, if you annualize it by 3%, actually we're near 2%. We're almost at 2% on a year-over-year basis. Again, I have all that data inside the last inflation report and on the macro report. But right now, let's read through some of this and then take a look at the market Right now, just FYI, the dollar is spiking, so not good. Dollar spiking, S&P is coming down, Qs are coming down. As this comes out, it was weak all day, so the dollar going up is not a good sign. Bond yields are kind of pushing up, not too bad. I mean, this shouldn't be too much of a scare. You know, a lot of it is already priced in. But let's read further on it. So Fed minutes. Amid uncertainty about the monetary policy lags, participants said rate hikes are working as intended. So they are saying rate hikes are working as intended. I'm going to switch this up real quick so we can see the actual chart. Let's see. Yeah, let's get a hold of the actual chart. Here we go. So they are saying that the rate hikes are working. Put myself down here. All right, you see the dollar spiking right now, so that's a negative reaction. That's a very negative reaction. It's a risk-off reaction. Bond yields also rising a bit on the 10-year. I wonder if the 30-year is rising higher. Down here, advanced decline. More stocks are starting to decline now, and I look at this, not just the SPY, because this gives us an indication of all stocks in the market. In intraday, how many are trading positive versus negative, right? They're trading negative at the moment. The reaction is negative. And then here we get the equal weight S&P. Again, another market breadth or broadening of the market, looking at the broader market and how that reacts. So we're looking at that. So I'm going to read this. Look, TNX is still moving up. The dollar is still moving up in the short term. And I'm going to go back to read those comments or see how the market is interpreting this. All right. So amid uncertainty about the monetary policy lags, participants said rate hikes are working as intended. Good. That's good news. Rate hikes are working. We know that. Participants still saw below trend growth, softer labor market as necessary to restore economic balance. Okay, so below trend growth, but that might actually, that means the labor market, right? So when we get payrolls, that's one of the biggest indications for wage inflation. Everybody always focuses on payrolls because if payrolls, you know, they were supposed to collapse and they never did. But if payrolls come down too far, then you get this, you get the Fed actually easing a little bit. But if payrolls are too hot above trend growth, then you may get a reacceleration in growth. I don't believe, or in inflation. I don't actually believe that though, because the real inflation is coming down to the supply chain. If more people are working in the economy and you're hoping they're actually producing more, not just sitting on their butts doing nothing and spending more. If more people are working in the economy and payrolls stay pretty sharp, then actually the supply side of inflation is pretty fixed, right? The supply side of inflation actually heals, and that's a good thing. So I don't think that's a big issue, but they definitely do want jobs to come down and no wage inflation, but we haven't seen wage inflation yet, right? We're not seeing wage inflation. That's what that's about. Next, participants said that gradual slowdown in economic activity appeared to be happening. Yes, we saw the manufacturing index, the PMIs, the ISM PMIs, or manufacturing activity in general is still below the 50 neutral level, right? Below 50 is contracting, means the economy and the manufacturing side is contracting, it's pulling, it's falling, and we're at 46. We've been trending, we might be bottoming out here, but we're at 46. So, oh yeah, and you can see there the dollar's still going up, bond yields are still going up. That's not good. That's tightening financial conditions in the left and top left and top right hand side, right? The US dollar and the bond yields, that's the big risk to the market. The more those bonds go up, right, the more those yields go up, it's not bonds, it's yields. The more those yields go up on the right-hand side, the more pressure and risk on the commercial banks in the US because their collateral is literally, their collateral is falling, right? Their collateral to back all the loans is falling, and they might have to default in some areas. They might have to sell some more US Treasuries, which actually puts more pressure on yields going higher. So a buyer needs to come in. Right now, the bond market does not like what it's hearing from the FOMC minutes, and the dollar is reacting also by moving higher. That's a risk-off move. So it looks like S&P is going to drop that 4,400 level that we've been pointing out, and it's going to go back to 438. That looks like the next support zone. All right, let's keep reading here. It's not really negative so far in the FOMC minutes, but the market is reacting. The market is wild. Did it look forward? Is it looking back? Who knows? So economic activity is slowing down, okay? And the manufacturing side, not the services though. Services are still hot. We're still above 50 in the ISM, which means services in the economy, 70% of the economy is services, still expanding. Consumers are still spending. We know that. We see all the data. It's always in the macro reports. Subscribe if you want to learn more, if you want to see more on what hear more about what I'm writing about when it comes to inflation and the labor market and all that. So next, Fed minutes. Participants said inflation was unacceptably high More evidence needed to be confident price pressures were abating. So yes, inflation is still pretty much high. Look, oil prices right now are still high. Services are still pretty high. The only two components that are keeping inflation high right now, FYI, is literally owner's equivalent rent for shelters. It's super laggy. Nobody cares about it, right? It's stupid, but it could just keep the Fed a little tighter, right? Number two, oil prices, but oil prices are falling right now. So that's a positive, right? This is just the immediate reaction. We'll see, and we're going to go over oil prices and how CPI could actually be in the 2% in the next inflation print over in, what is this? This is going to be the August CPI. So September, right, next month, it's very possible if this continues, we see oil prices actually give inflation a 2.9%, and that'll be very positive for stocks. That'll be positive for the economy. Gas prices will start to abate again. We're going to go over that. But anyways, they need more. Okay, yeah, core inflation is tight, but owner's equivalent rent, they're looking back 6 to 12 months and reading that CPI. So I think the Fed is going to over tighten here because they're looking at thoughts on the yield curve. Yes, we will get on the yield curve. The yield curve is very important. The Fed is looking at lagging data and really making choices to hold rates here. That's okay. That's fine. They're going to hold rates. So they're very restrictive. So they're in very restrictive territory. The more they hold these rates higher, the more chances that the recession does come. So far, we're not seeing that. Actually, we'll go over GDP. GDP got revised up again by the Fed. So economic growth is accelerating, and they are fearful that will accelerate. Will not accelerate inflation, but actually keep inflation higher, a little stickier in the services side. Okay, so that's definitely a risk. We'll keep our eye on that. Next, participants said the labor market was still very tight, although signs emerging labor demand is better and better balance. Okay, so yeah, labor is very tight. That's not a bad thing necessarily, and demand is in better balance. So more people are coming into the workforce, and there's less jobs available. So it's just all about wage inflation. Anytime you hear, okay, just FYI, anytime you hear the Fed says we need the labor market to come into balance, what they're basically saying is we need the risk of wage inflation, so people's wages accelerating to not go up, right? That's a risk. If your wages go higher, that takes away from company earnings, or S&P companies, or equity earnings, and it also means people could spend more. I don't think, it's more psychological. If your wages go up and you think, oh, we're heading to recession, you might actually save more money, put it into that cash money market fund, right? And actually collect more interest. And then you probably do spend more. So at the end of the day, they're saying that it leans towards more spending. And I still don't think that's a bad thing. So it's down to wage inflation. Are we going to get wage inflation that would weigh on the economy? Fed minute, most participants said inflation risks could require further interest rate hikes. Okay. So that's not great. Most participants are saying inflation that, we should hike again over there in September. The only thing that would change their minds possibly is going to be this whole downgrade. Hello, mate. What up, Slime Z Bukowski? How you guys doing over there on TikTok and YouTube? So basically, I think this banking risk could cause the Fed to actually pause here. If there is no real risks, if those bond yields, and we're going to go over the Treasury market, because if the Treasury market continues to fall apart, then we definitely will get the Fed having to step in and pause. There's no way they hike again. Another hike would guarantee that collateral falls even further from JP Morgan, Wells Fargo, Citigroup, whoever it is, right? And they'll have to get downgraded for sure because their collateral is falling, okay? FOMC minutes, July meeting. This is from the July meeting also. A number of participants warned of risks of accidental tightening policy too much. Hey, that's a number of participants. Well, is that more or less? Who knows? This is the risk we're seeing right now in the market. This is what the market is worried about, is that if they do keep tightening, so this is kind of contradictory, which is, oh, we need to keep hiking, right? Most participants, but they also warn risks of accidental tightening, which I think they actually might not mind if that happens, which would be a downgrade in the debt for a downgrade in the collateral for the U.S. banks. And if that debt does downgrade, right, if the collateral does get downgraded, there's going to be a wash on U.S. Treasuries. There's going to be a wash on the stock market. People are going to sell. They're going to get scared because of recession risks. And then we look to see if the Fed actually steps in and pumps the balance sheet again. Because what happened last time when we got banking risk in March? You guys got to think about this. What happened during the banking risk? The Fed came and created the Bank Term Funding Program. And they funded all the deposit losses and basically back the banks, the S&P bounced. So this could be a scenario. The banks do fall apart. The Fed wants a crash in some of the banking sectors. They let the banks crash, but then they come right back in and they pump more liquidity to cover up those banks or to backstop the banks. So you do get an initial negative reaction, and then all of a sudden the stock market says, okay, you're going to come back in and back us up. All right, cool. So I think that is a very, that's interesting. The real question is who's going to buy these U.S. Treasuries? The U.S. Treasury bond market is falling apart. And if it continues, then you could have more systemic risk. All right, so China's GDP has transparent issues. This is just the White House. I think that's about it. Let me make sure that Zero Hedge also does some tweets on it. I think, okay, everybody has a different take on the FOMC minutes. I'm just trying to dissect them. And so far, it looks like they are acknowledging that there are bond market or treasury market risks, which is the U.S. debt, right? If U.S. debt is not bought up, that's the U.S. Treasuries. If that debt keeps falling, the collateral for the U.S. in general is falling, and therefore loans start to default. And that's the big risk. I'm not saying it's a big impending warning. We already see it, but it does need to be taken care of. And the market's like, hey, who's going to come in and resolve the treasury market? The treasury market's moving higher. Okay, what are we looking at now? Now the dollar's pulling back. Now the S&P is finding a bottom here. Yields are starting to pull back a little bit. All right, so since the emergence of stress in the banking sector in mid-March, indicators of spending and real activity have come in stronger than anticipated. As a result, the staff no longer judged that the economy would enter a mild recession toward the end of the year. These are the FOMC minutes. This is the Fed saying, hey, we no longer see a recession. Okay, so this is them talking about the economy versus the banking sector. Next, while the overall banking system retained ample loss-bearing capacity, some banks experienced sizable declines in the fair value of their assets as a consequence of rising interest rates. We just talked about that, right? And that's that chart in the top right-hand corner. As long as this goes up, okay, as long as these TNX, the 10-year treasury rises, which you're really think in reverse, think of the opposite, you're getting the bonds or their assets actually losing value. So that's what the FOMC minutes are saying. Hey, we see sizable declines in the assets of the banks from rising interest rates. So they kind of know what's going on here. If interest rates keep rising, not from the Fed, well, yes, from the Fed, but also from the bond market. Those are two different rates. The bond market is the market rates. Those change every day, right? Or 5 days a week, the bond market moves. Those are rates for the market. But the Fed funds rate is rates for the bank. So what they're saying is, hey, we see that if we do continue, we could cause more banking stress. And if they do that, that's fine. They might do it. They might just hike rates again in September. And, that's debatable. But if they do and they cause more stress, well, look for the Fed's balance sheet to step in and to fill those gaps when they do happen. FOMC minutes commented that monetary policy tightening appeared to be working broadly as intended. So monetary policy, they say, has intended, but the Atlanta Fed GDP, and I'm going to jump over to the Atlanta Fed GDP has actually revised higher to 5.8%. So right now, the prospects for the economy are actually rising considerably. We're seeing the prospects for the economy rise considerably. And so the rate hikes aren't really working for the economy, but they are working for the banking sector. They are working for inflation. So we are seeing inflation abate a little bit. So let's see. I'm going to jump around a little bit. We're going to go to, actually, let's see if there's anything new that they're saying. We basically went through the changes in the minutes, and then we're going to go to technicals. We're going to go look at the S&P 500. We're going to look at the bond market, what's really plaguing the markets today. What is really the big risk? It is that interest rate. It's not interest rate risk. It's collateral risk. That's what we're looking at, collateral risk here. So, and then we'll look at some of the economic data that is coming out. But first, let's make sure that we did get all of, no, we don't need that. Let's make sure we did get all of hear what they had to say about it. Maybe they're going to say the same thing. All right, let's listen a little bit more.
And stick around for just a moment for more reaction to the Fed minutes. Let's bring in Stephen Stanley, Chief U.S. Economist at Santander. Mr. Stanley, welcome. Good to have you with us. I'm going to call you Mr. Stanley because we've still got Steve Leisman. I don't want there to be any confusion. What's your reaction to what they said?
So it sounds like what we heard from Chairman Powell a few weeks ago, not surprisingly. I mean, since the June meeting, from June to July, the growth data was stronger and the inflation data was softer, and it kind of offset. And I think that left them more or less where they had been in June, which was most people were thinking they were going to have to go a couple more times. So that would be one more past July.
One more past July. Do you expect that to be September or not?
I actually think they'll skip the September meeting. I think they're on an every other meeting tempo. So they skipped in June, went in July. I think they'll skip September and then take another look at it.
Now, that would be very positive. He's basically reflecting the fact that GDP or the economy is strengthening, right? The forecast for gross domestic product or total spending in the U.S. is increasing for the third quarter, Q3, while inflation is actually decreasing. And he's also saying, this is very bullish, right? This is very dovish. This guy's not very, he's not very hawkish. He's really dovish here. He's saying, I don't even know who he is, but we're just interpreting what he's saying. Basically, the Fed will skip in September. He thinks the Fed will skip in September. That's a very bullish take, right? The Fed skips while GDP goes up, while inflation comes down. Very bullish for the market. Hey, right now the market is moving higher. It's almost back above VWAP. The dollar just collapsed. So the dollar, the dollar is collapsing. And who is this? The dollar's collapsing and bond yields are coming down. So now the market is starting to interpret this as very positive, right? The market is interpreting this as a positive. Therefore, the collateral is not falling after this meeting. The Treasury collateral is going up, and the yields are coming down, right? This is all. Inflation has been the biggest risk, but now that risk is pouring into, will the U.S. collateral, will it collapse and cause a bigger banking crisis? That's really the question here, just to put it in your head. All right, let's finish on what this guy's saying. He's given a very dovish take on it, very positive for the market, and then maybe they'll throw in a hawk.
November the last for a while?
I think it is.
Wait and watch, and
it depends on the data, of course, but I think it will be. Yeah.
And what about the point that Steve made, talking about disinflation and housing to relax those hikes? I mean, that is.
Hey, just FYI, I know you guys asked about the yield curve, FOMC minutes. Yes, I will go to make sure you're subscribed to the newsletter. I'm going to release the FOMC minutes through the newsletter by the end of the day or a little later. I will do a summary just so you can read it. I'm going to summarize it in words and send those FOMC minutes out today. So check that out and kind of my comments. Okay, what does this mean for the markets? How's the market responding on it for the FOMC minutes? So if you want to check that out, go subscribe. It's a free newsletter, by the way. Just check it out. Link in the description in the bio. And for the yield curve, we are going to get to the yield curve. I just want to finish up on some of these CNBC contributors to hear if there's anything contradicting. Is there anything I'm missing? I don't know everything, right? Is there anything I'm missing? Is there, what are the takes here? How do we interpret these guys? Because it's very confusing, right? They use all this terminology. Let's simplify it.
Been a key sticking point.
Yeah, well, we've gotten some better data on inflation, and what I think we're waiting to see is if that has staying power. Is inflation going to continue to decelerate, or is it going to stay hot? I mean, the Fed models would say that if the labor market is as hot as it's been, inflation is probably going to stay pretty high. And so we've gotten good news, but it's not clear whether it's going to persist.
So in this environment, how long would you have to see a trend of less hot inflation, if not deflation, to sort of feel like, okay, we're on more solid footing here?
Yeah, so we have 2 months of good CPI numbers. I think if you get, 3 or 4, then you're starting to get to a point where you can say, okay, at a minimum, we can be very patient. Maybe we don't have to go, or we can just pause for a while and see what happens. But there's always the risk. Inflation may come down for a while and then reaccelerate, right? So you're always kind of hostage to the data.
How do you handicap recession risk, if at all?
I don't think we're going to see a recession in the near term. I think the consumer is still very...
Okay, look, kind of boring. He's not really saying much. I want to see if he had comments on the FOMC minutes. He doesn't. He's kind of just talking about what he sees going forward. Look, there wasn't a whole lot of surprise in the FOMC minutes, FYI, for those of you who are listening. I'm going to check out what I'll send out in the newsletter what actually changed. So let's get back to how the market's reacting, and then we'll do some technicals, but let's look at how the market's reacting in the short term. All right, I'm just going to highlight this really quick. So first we get that upside burst, and the dollar, right? The dollar bursted higher, and that could have just been, okay, if anything is too negative, maybe it's algorithms, who knows what. Bond yields also went up here on the right-hand side, right, which means the collateral is falling, the bonds are falling. And then we had the market actually sell off initially. Now the market is back up. Now this isn't like, you know, we don't know. We still have what, 30 minutes for the market to close. We still have some time, or actually probably more than 30 minutes. We still have, no, we still have like an hour for the market to digest this. We have some time, right? So the market's going to be digesting this. It could go right back down to the lows. We don't know. We're just taking a look at how it's reacting initially negative, now initially positive. Advanced decline maybe have bottomed out for the day. Okay, but we're at VWAP. You guys don't see VWAP, but we are at VWAP. And actually, I'm going to switch this over so you can see what I mean by VWAP. Let's go to SPY. Okay, and this is the big trend too. Look, check this out. I want to highlight this really quick for those of you who you know, are not familiar with the technicals. This chart I have up here is basically the weekly chart. Okay, and you can see we're still in the uptrend. Okay, the market is still in the uptrend. We could easily come back down, retest the bottom of the trend. I don't know if we go that far based off these FOMC minutes that are basically saying, hey, there's banking risk. We might have to pause here. The market is looking for a pause. I don't think this report or this FOMC update on the minutes calls for a further falling of the S&P all the way back down to the trend. But we could trade sideways, even leak below, and hit the bottom of the trend. So we're still in the uptrend. Okay, from the lows, we're still in an uptrend, not a bear market yet. More of a buying opportunity when we see a sustainable, sustainable support, right? When we see the buyer step in. Also, we did drop the 50-day moving average. This is not the 50-day moving average though. This is actually the 12-week moving average, which is the 12-week moving average. I believe, let's double check it here just so you guys can see. Oh, it doesn't show up on your guys's. Okay, it's the 13. It's the 13. So you can't see it on my screen, but this is the 13, the 26, and I believe the 42. And what it is the 13 weekly moving average, right? The 13 weekly moving average is a representation of the last quarter of earnings. So this is a moving average that tracks the quarterly movements of the S&P 500 on average, right? So the last quarter of earnings, the last 2 quarter of earnings, and the last 3 quarters of earnings. So I'm looking at the quarterly rotations because really markets move off earnings, right? So we're actually supporting that. We didn't drop it yet. We didn't drop the 13 weekly moving average, which is the quarterly, the last quarter of earnings. The market is still bullish against the last earnings reports, okay? And we still have more earnings to finish up here going forward. We're pretty much done, and we did better earnings. So that's what we're looking at initially. Now, on the daily charts, you can see them up here in the up-hand corner, or the upside corner here, the Qs. The Qs right now are, and I want to go through more of these charts before we get there, but you can see in the left-hand corner, the Qs are trying to get above VWAP. I'm going to highlight it a little more, right? That is this is VWAP. So institutions sell at the bottom of VWAP. We're getting above VWAP. This is very bullish. I actually want to see what is Tesla looking at the moment. I'm very interested getting long Tesla here. It could be bottoming out. A lot of bottoming here. Oh, you guys can't see it. A lot of bottoming here on Tesla. It looks like the S&P. So we have a lot of technicals to get to also. And I know we are jumping around a little bit, but I just wanted to show you when we look at the quarterly moving averages, the S&P is still holding up. How about SPX, right? The big index. It's also at the last quarter of earnings. So we're still holding the last quarter of earnings and I want to see this after the FOMC minutes, because this is the big headline, right? The market is trying to decide what's the Fed going to do. Are they going to hike rates? Are they going to cut rates? Is there any signal of cutting rates? We actually didn't get any signal of cutting rates yet. We did not get any signal of cutting rates. But we will talk about the cutting rate signals, which are that which is the closer we get to 2% CPI, right? CPI 2% or core, then we can cut rates. So, ooh, now the market's making a big run higher. Okay, so that could have been it. We are bouncing. We are showing support off the last quarter of earnings. Okay, NDX. NDX. So now we're looking at the look at this. This is tech. This is basically tech. Tech is it's not really above that quarterly moving average yet. I think we're going to see the return of tech. Okay, we've had tech make the biggest run higher technically, and then tech kind of, this is the weekly chart, so it's a little bigger, but tech ran out of juice, but it led the market higher out of this bear market from March all the way through June, July. Tech led. Then we sold off, right? Apple came down, and you saw IWM start to rise. You saw the Dow start to go up, And the Qs have actually had the largest sell-off from all the indexes. The Qs, the Nasdaq, technology names, the mega cap, whatever, they've had the biggest sell-off. Okay, now I think we're starting to bottom. Could be wrong, right? If those interest rates keep rising, we could go lower. But what I'm saying here is I starting to see some divergence between the Qs and the SPYs. It looks like the Qs are actually starting to get some gain some ground here. So this is NDX still above that quarterly moving average, still in the uptrend. Okay, how about the Dow? Right, Dow still in an uptrend, right? And it hasn't even touched back at the quarterly moving average. So maybe the Dow comes back to touch the last quarter of earnings on the moving average on the weekly, and while NDX and SPY continue to bounce. How about IWM, small caps, right? Small caps are actually already at that moving average at the last quarter of earnings. So small caps are there. Small caps also will struggle a lot more with these higher interest rates because most of the companies have not earned yet, right? They're not in positive territory, meaning they're not positive on their earnings. They're still, they're still super growth companies. They're very sensitive to interest rates. So IWM, small caps, and tech, QQQs, right? NDX, they're all going to be a little more sensitive to those higher interest rates versus the Dow, who has outperformed a little better, right? We've seen that Dow actually outperform a little better than that. Okay. So, yeah, those are the indexes in the short term, right? I know some people wanted to look at Tesla. I will go over Tesla. I would like to hit 220. Yeah, 220 before longing the last time it filled the gap and broke past it. Yeah, I think Tesla's near oversold. So really quick, I don't know if a lot of you guys are Tesla fans, but Tesla is getting on the daily chart, is starting to get to that oversold RSI territory. I love the RSI. We're almost there. Look, we're almost at oversold. You want to see a little bit of a bullish divergence where the RSI actually starts to turn back up after it goes oversold. And then you see the price still kind of lagging. That's a buy signal for Tesla. We're not seeing that yet. Okay, we saw that back here. So that's what we're looking at there. Now, before we get to Tesla, and Tesla's still on trend, really nice on the trend. Before we get to Tesla, the bond market, okay, the bond market, I wanted to show some of these charts, kind of why equities I don't think are going to fail as much as people might think. Okay, so first let's check out debt as in general, right? US Treasuries right now are selling off. So I'm going to go to actually, let's see if this works. So let's go to this. Let's take a look here. Hey, this is a positive, by the way. Okay, this is a very, very positive for the market. And this is the chart of crude oil. We're looking at crude oil here, right? Crude oil is getting rejected at this level. And what I wanted to highlight before we get to the Treasury market, because this is the macro, this is what matters right now, especially for the yield curve. This is what matters right now. What else we got? Yeah. Okay, so the only reason CPI bounced higher because this big move in crude oil. This was a big move in crude oil prices, right? From July to this was the whole month of July. Okay, this was the whole month of July. So in August, right, we just about a week ago, we got the inflation report last week. It was literally last Wednesday or Thursday, right? We got the CPI report. That CPI report is reflecting on this month of oil, and oil was up. Let's take a look. How much was oil up on this month? Oil was up nearly 17.5%. I just call it 20, but it's up nearly 17.5%. That pushed CPI higher. Okay. So now we're in this month, but guess what? We hit the 83.50 level. This is the big resistance zone, 83.50. You could even say 85 really. And we hit that zone. So we're coming off the 83.50 zone. So what I'm thinking here is, all right, well, CPI, as long as we even trend sideways or go lower, CPI is going to come in way better next month. We are not going to chug higher on CPI. CPI went from 3%, right? It went from 4 to 3, big move down. And then it went to 3, from 3 to 3.3 during this month, 3 to 3.3. So as long as we, come off this resistance, well, I'm looking at back to 3% or even 2.9, right? The further it goes, the more I'm bullish that CPI is going to come in very weak, and the Fed can now pause and actually start talking about cutting rates maybe not say we're going to cut rates, but actually bring in the language, right? The language for cutting rates. So they're not going to say, hey, we're talking about cutting rates. They're going to introduce cutting rates in that next meeting. People are going to ask them, hey, are you close to cutting rates, right? So I think it really depends on this oil price. So as long in this zone, this is the month of August, right? We're going to get the September reading, the September meeting is going to look back on this August data, right? And oil is a big input to inflation. So as long as we stay below 83.50, as long as we move sideways or even lower, expect that CPI to come back down underneath 3.3% headline anyway, maybe even into the twos. Okay, keep that in mind. That's very bullish. So far I'm getting a little more optimistic about S&P bouncing because oil is not going any higher. And if you look at commodities as a whole, I know some people are saying, well, commodities are set to go higher. Well, I'm looking at the price, right? And when I look at copper, where's copper at? When I look at copper, copper is also falling because the China recovery is weak right now. China has to re-stimulate, and we just talked about yesterday, they cut rates. So they had to cut rates because of the weakness in the economy. So copper is also down, one of the biggest inputs to infrastructure builds, right? So when you build infrastructure, copper is probably, whether it's technology, chips, whatever it is, copper is one of those biggest commodities. So far, oil and copper are not moving up, they're moving lower. So that's good for inflation and really takes off commodity inflation as a force right now. That could change, but right now that is not a force, okay? So taking a look at those two. Now the dollar is at the top of the range, right? Hopefully today, after the FOMC meetings, what I'm thinking is the dollar was front running this meeting. And well, I don't want to say the dollar was, but people fear in the market is front running this meeting. The dollar's hitting the downtrend, right? If it rolls over, as we roll over, bid back into S&P, bid back into crypto a little bit. Crypto's more regulatory, right? It's all about regulation, but you get the bid back into crypto, you get the bid back into the S&P if the dollar can roll over. And that's going to depend on rates. And also the dollar's at the top of the RSI, it's nearing oversold. We get oversold and there's really not too many risks. The risks are not as bad as we thought they were. Dollar rolls over, boom, there goes a tailwind for the market right back in, okay? Now, here's where everybody's worried, okay? Let's go to the 10-year, actually start at the 30-year. 30-year yields, always when I show this chart, you have to think, right? You need to think, and it's a little overbought here. You have to think that when this chart is going higher, in your head, do a flip-flop and say, oh, that means bonds are going lower. Yes, this is the reverse. So 30-year bonds are falling, the collateral is dropping, pushing yields higher, pushing mortgage rates higher, pushing demand lower for housing, pushing demand lower for a long-term borrowing, which is more so technology like crypto. As long as this goes higher, you're basically putting pressure on long duration assets, which is like crypto, technology, very long out in the future is where their earnings are at, okay? So that puts pressure low. So that's not good. This is a negative. This is a headwind, okay? This is what the banks are worried about. This is what Fitch, the downgrade, and Moody's are all doing. They're saying, oh, shoot, the collateral's dropping, interest rates are going higher. Sorry, we're going to have to downgrade you because your assets, your debt, you're holding U.S. Treasuries, which are a form of debt. Your Treasuries are losing collateral. They're losing value. All right. So 10-year, same thing. 10 years moving up. This is a big bit on 10-year. Now here's kind of the positive. The 5-year, the 2-year are not really moving. So short-term growth is actually not bidding higher. For short-term rates are not moving higher. And if short-term rates stay here, then GDP goes higher because most of payrolls, most of what companies have to pay for payrolls, most of the economy's borrowing happens at the short end. So the short end is not moving higher. The short end collateral is okay right now. And if we go to 3-month and 6-month, this is 2-year yields or 2-year debt. If you go to 3-month and 6-month debt, it's actually getting bought up. It's not really moving because there's a lot of yield. There's a lot of incentive to own 3-month and 6-month notes. Okay, or bills, whatever they're called, notes or bills. I can't remember at the moment. So there's a lot of incentive for that, all right? Next, okay, so next, here's why I think, let's look at S&P really quick. We are dropping that level, right? But we could be reversing today. So here's the technicals for S&P. We might be getting a reversal candle here, right? And this is following the FOMC minutes. This is why we needed to see that. We needed to get past FOMC minutes to see if we can reverse here. So maybe we get a reversal, maybe not. But so far we're getting that candle, okay? Today's this candle. This is a doji candle. So it's either going to end red or it's either going to end red or green. If we end red, maybe not, right? I'm looking at the actual. So on a technical basis, if you're a technical trader, then you understand how candlesticks form. If we close below the previous wick right here, right? If we close below that wick, then it's more bearish. Then maybe the sentiment or the positioning remains negative, or positioning still is selling S&P. Okay, but if we do hold support above this wick and we get this to close green, this could be the reversal for the market, for the S&P in general. This could be the reversal. Okay, jump into the Qs. Qs are still holding support here at 364, 365ish. The Qs are still holding that support. Dow, right? Dow has still room to come back into support. We're not really worried, right? So equal weight kind of looks like trash right now. Those are that's what we're looking at there. So that's the technicals for that. Now, why is it that we may see SPX still move higher, okay, or still hold on here? Now, SPX looks a lot weaker than SPY, okay? So yeah, that looks very bearish. SPX looks a lot more bearish. NDX also looks more bearish. SPY looks better. So just keep that in mind. SPY looks a little better, and we got to see how it actually finishes there. So jumping over to the to this debt thing I wanted to talk about. This is equity debt, and what you're seeing here, this is why the equity market is still moving higher, or in general, I guess what I would say is, I guess the way to put it is, we always look at triple B spreads, right? Or HYG is the high yield corporate bond ETF. So this is the stock market's debt. So, and holistically, are people buying the stock market debt, right? Are they buying equity debt? It's good if they do, because people are taking risk. If they are, they're confident that the stock market or companies or equities in general are going to, show performance going forward, right? They're not worried about the collateral collapsing. There's actually more risk in U.S. Treasuries right now, Treasury bonds, than actual equity bonds. These are equity bonds, right? So people can own this debt. They own this debt. It's still going high. It's trending higher. They own this debt. And if they own this debt, they get paid an interest rate. For instance, Microsoft might pay you 2.5% to hold their bonds, right? Every company in the stock market has a bond, just like the U.S. Treasury does, and they pay you a percentage on that bond. So what it looks like is investors are actually more confident in holding U.S. Treasury bonds to get that coupon or to get that interest than holding than holding U.S. Treasuries. So they're more confident in stocks than they are in the government, which is very interesting. Okay, very interesting. Usually that's stocks are supposed to be more risky, but we're not seeing that happen, and that is actually reflected in these triple B spreads. And the triple B spreads is the difference between buying pressure in Treasuries and buying pressure in equities. So if it goes up, like back here during 2022, this was saying, oh shoot, let's sell equity debt and go into Treasury debt, because equities are facing inflation, but maybe we should buy Treasuries because the government isn't going to default, where a lot of these companies could default. That's actually came down. So we're seeing more confidence in the equity market, right? So investors who like fixed income, this is basically about fixed income. They'd rather get their fixed income from stocks, from the stock market, than get their fixed income from the government. That's basically what that means. Now, this next chart, it tells us why, okay? Hopefully I can transition to this smoothly. This is why, because most of corporate debt, or let's put it this way, 75% of U.S. corporate debt, S&P 500 debt, is fixed. So it's not really getting hit by the rate hikes, right? All of the interest rate hikes are hitting banks lending, but it's not hitting the stock market. So again, more than 75% of corporate debt is still at a very low interest rate. It's not getting affected by the Fed rate hikes. And this is another testament to why the stock market is so resilient, because again, that debt is not getting hit. So here's another chart, also reiterating that. Okay, so this chart is showing us that nearly half of S&P, oh, can we see that? Yeah, there we go, we can see it. So nearly half of S&P debt is set to mature after 2030. So again, nobody's worried because most of the maturity of the debt doesn't happen till 2030, right? Meaning, if there are risks, those risks are going to come on the table as we near maybe 2029, maybe 2030. Then the risks come on the table for equity debt maturing at maybe you have to roll your debt, and this is very complicated. Let's just put it this way: there's no risk in equity, owning equity debt or equity fixed income until after 2030, right? We'll look after 2030, so there's no risks there. There's no really risk in the equity debt, more so in the treasury, right? That's where the risks are. Okay, next chart. The next chart I think is let's go here. Yeah, this next chart also shows us why the equity market will continue to be resilient. Okay, corporate interest costs as a percent. See if I could show my mouse on it. There we go. So here we go. Corporate interest costs as a percent of profit. So what you're looking at here is the cost of your profits, right? Your margins are much lower, right? In black, have been falling since 2020. So the cost to run your business, basically, or the cost that getting took out of your profits, if you look at the whole S&P 500, are falling versus interest rates. This is why the S&P or the equity market is so valuable right now, because the costs are not rising to own equity. Equity is rewarding you. Where if you own treasuries, they're destroying you, because treasuries, the treasury collateral is falling, and as the Fed increases rates, so as they increase rates, the bond market matches that. So Fed hikes are not affecting corporate debt. Okay, Fed rate hikes at 5.5% are not affected. Now, what happens when they drop? That's going to be insane. Typically, you can see here when the Fed does start to cut rates, maybe not till, I think the soonest we could see the Fed cut rates in September. Okay, October. I think the Fed could cut 25 basis points in October, but there has to be a special situation from that. And that is oil dropping significantly, and that is shelter finally starting to run to zero, are starting to fall into the CPI because we're measuring lagging prices. So when they do cut rates, what happens to corporate costs? They decelerate significantly. So corporate debt or equity becomes way more valuable faster as they cut rates, right? And so right now we're falling despite the rate hike. So what happens when they cut? You're going to get when they do start to cut, you're going to see corporate costs of profits fall even further, or margins increase. Okay, margins increased even further. So equities are set up really good here. And that's why I think we're not really dropping. When it comes to equities, we're not really going to see a significant drop unless there's a black swan event. Okay, I keep saying that, unless there's a black swan event. Next chart. Okay, next chart here is, let's put this out there. And this will all be in the newsletter. If you're not subscribed, go check out. It's free. Link in the description. Link in the bio. It is the weekly macro newsletter. It goes over a couple technicals, the macroeconomic data, so you can read it yourself. All right, so next chart here is, okay, the negative effects of higher cost of capital continue. So this is when it comes to banks. This is really the story in the market right now. And I sent an article out yesterday about this, the Fitch downgrades or the banking downgrades. And what this really is showing us here is bankruptcies, right? Bankruptcies. And this is when the Fed started to raise rates, right? March of 2022. The Fed started raising rates here. As they raised rates, what's happening here is, as the Fed raises rates, right, to tighten capital, well, the U.S. Treasury market or the bonds start to lose collateral. The bond market fell significantly. The bond market actually had the biggest drop in history. Okay, so the collateral for the financial system, because the U.S. is the biggest financial system, the collateral has been dropping significantly because of inflation too, right? But just keep on tracking that. If the collateral is falling, you're putting banks at risk because they're lending out $10 for every dollar, right? Fractional reserve banking. Now, if their $1 drops to 50 cents, now can they keep lending out $10? No, because now that $10 is worth only $5, right? So they have to sell their treasury. So the bankruptcies have been increasing over time as they've been hiking these rates. And sorry, I didn't mean to do that too much. So and so this is just a testament to. Come on, zoom out. I didn't mean to zoom in there. Dang. Zoom out. There we go. All right. So the negative effects of higher cost of capital continue. Right. What is it? What do I mean by the higher cost of capital? This is why I always point out the bond market. Right. Keep this in mind. The cost of capital is the bond market. The cost of capital, the cost of borrowing. Right. Every company, every business, every corporation on earth borrows capital. And that capital is either higher or lower over time. And that is determined by the bond market. Okay, so this is why we keep our eye, okay, and this will all be on our newsletter. This is why we always keep our eye on this chart. Okay, this is why we keep our eye on this chart, not this one, but the benchmark rate, right? This is the benchmark rate to all capital. And guess what? It is moving higher in the last 2 days. This is the daily chart. It's moving higher. So if the cost of capital keeps rising, we expect more bankruptcies. That's what basically these rating agencies are saying. As the cost of capital rises, we expect more bankruptcies to happen. And that would be a catalyst for the Fed to say, okay, we're going to pause here. We're going to pause here because more banking crises are coming. And what we should also see as this rises, we should see a banking collapse, and then we should see the Fed's balance sheet, right? It's dropping. This is the Fed's balance sheet assets. So assets on the Fed balance sheet or U.S. Treasuries, they're selling U.S. Treasuries. So they're pushing the bond market lower, right? They're actually affecting the collateral. They're pushing the collateral lower and the rates higher, right? Literally, you see the opposite happen. But what happened back here in March of 2022? Because I think we might see this. I think, right, I'm anticipating if we do get more banking crisis, if these rates go higher, we might see the balance sheet explode higher because the Fed will have to step in. The FDIC will have to step in and start to resolve some of the banking issues, which is basically just a lack of liquidity at the banks. They had to sell their U.S. Treasuries, right? They can't lend as much. Consumer deposits are at risk. So we're watching this chart. Okay, we're watching the bank to not the bank. We're watching the Fed's balance sheet to have to purchase more assets and then therefore inject liquidity into the market and therefore bring rates lower like they did last time, and therefore give the S&P more confidence that there is no systemic risk, right? Maybe it doesn't happen, so we're going to keep our eye on that. The other part is GDP got revised up again, okay? So this is GDP now, right? This is the Fed, so this is the Atlanta Fed, part of the Federal Reserve. They keep raising their estimates from July. Now we're in August. Look at this. GDP is now revised up to 5%. I think I posted this, this is today, is released. Okay. So GDP keeps rising, which means growth is accelerating. Okay. Slowly, mostly in the services sector, growth is accelerating. I think even manufacturing is starting to bottom here, while inflation is falling. Okay. It is falling on a year-over-year basis. Okay, this is the macro. This is a perfect setup for the S&P, which is why I think the S&P is just looking to find a bottom here, right? Where's the bottom? Now we turn over to the VIX. Does volatility really look like this is a big risk to us? Volatility is going nowhere, right? We had a big spike, August 8th? I don't even remember what that was. Maybe it was the first downgrade. This was last week, our CPI. This must have been the downgrades of CPI. That was the biggest spike. So far, volatility is not responding. Nobody, right? Watch what they do, not what they say. You hear, by the way, what's his name? You hear the dude, dang, I can't remember his name, basically made a bet, right? He bought like $800 million of SPY puts and QQQ puts. Dude, that was leverage. He bought options. You could buy literally, a bunch of options for like $40,000, but the value of those options are going to be 800 million. So he's not necessarily short $800 million. Michael Burry, he's not really short $800 million. You really think he's putting $800 million of puts? No, he's not. So volatility is not responding to the FOMC meeting. It is not responding to the CPI. It is not responding to these guys. There you go, Michael Burry, making these bets. Volatility doesn't care. Volatility is not bidding up, okay? Nasdaq volatility going nowhere, meaning, hey, we don't care. We're still more comfortable with holding equity. Bond volatility, on the other hand, is starting to pick up. This is what we do need to worry about, bond volatility. The higher bond volatility goes up, the more likely lenders, right? Lenders, banking system, whoever it is, lenders are going to actually increase their lending rate because the collateral, the bond market falling, right? Let's go to TLT. we see the bond market is falling. It just made a new low. This is terrible. Is the Fed going to step in? What's going to happen? The collateral of the system is falling. Okay, this is not good. So so the response to the bond market is, okay, if your collateral keeps falling, you guys all know if you're using margin, it's exponential. So if your stock falls, your margin falls significantly, right? You're going to have double the losses if you're double leveraged. So the bond market is falling. Therefore, the MOVE index or bond volatility is picking up. And if bond volatility picks up, lenders are saying, oh, shoot, or it's a reflection of lenders saying, well, your treasury collateral is at risk. So we're actually going to charge you more to borrow money. So this is really more of a negative factor. Let's see if it makes a new high. Hopefully not. Okay. Hopefully not. That is the risk right now to the market. That's what we're looking at is, will the MOVE index continue to climb? Okay, now we had some questions about the yield curve, okay? We had some yield curve. Let's see if I can find the U.S. Treasury yield curve. So here's the yield curve, right? This is what everybody worries about. This is the yield curve, by the way. And I don't think most people know what it looks like. This is a negative yield curve, right? You have short-term rates, and these rates go from, let me move this up. Damn it. I don't know if I can cover this. No. Okay, I don't know if that's appropriate for YouTube. Okay, let's get that off there. Stop with the ads, damn it. All right, so this is the yield curve, right? And this represents short-term borrowing all the way down to long-term borrowing, right? So 1 month rates, meaning, hey, if I buy a U.S. Treasury, the collateral for the bond market, the collateral for the system, if I buy 1 month, I can collect 5.5% interest. That's really good for 30 days. 5.5% interest at 30 days. Very attractive, right? The problem is people who want to borrow for 1 month are paying 5.5%, probably more actually. They're actually probably paying more because whoever owns those bonds is going to lend them at a higher rate. They're paying a high rate to borrow for 1 month. So it's kind of a positive and a negative. If you're an investor, it's positive. But if you're already owning these yields, if you already own 1 month treasuries, it's negative for you. You're underwater, right? You're underwater. And that's negative. So the yield curve, you go out to the 30-year, right? This is the furthest out. The 30-year is a little lower. So everybody says, well, what is that? What was the question the guy said? Thoughts on the yield curve currently. So basically the yield curve this is a negative, this is a inversion, right? Meaning that, and I have a whole post on this. It's literally the yield curve. Let me throw it out here. Oh, let's look at this. I sent this out yesterday, right? Stocks tumble off potential bank downgrades. If you want to read it, this is basically all the data that came out about the banks. And I just want to point out here, right? Bank of America, JP Morgan are double A rated. They're at risk to get downgraded, right? With JP Morgan, Wells Fargo. So this is basically the tiers of how strong a bank is. Does it really matter? Not really. What really matters is, they're not going to get downgraded too far. But what you want to look out for is these PacWest, Bancorp, Western Alliance, are they going to default? Look out for these names down here to actually default because they're actually holding U.S. Treasuries also. And if that collateral falls, they might be at default. So if you want to look into that. Other than that, the yield curve is very confusing. So yield curve, let's see if it's on here. Yield, tracking financial conditions with the yield curve. Okay, this is just some of my writings. I wrote this a couple years ago. And this is just basically breaking down the yield curve so you kind of understand, right? Oh, I might have to update it. Steepening yield curve, normal yield curve, flat yield curve, inverted. Right now, we're inverted, right? Short-term rates are falling and short-term rates are elevated versus long-term rates, okay? So this is normal. A normal is economic expansion. We're not there yet, right? We're not in a normal. Normal would be that the yield curve, let's see if I could flip this over. Normal would be that the yield curve, this comes down and the long side goes up. That would be a normal yield curve. We're not seeing that. There's two ways we get there too. There's one way is very risky, one way is very good, right? One way would be positive, one way would be risky. Okay, one way would be positive, one way would be risky. Steepening yield curve usually is a signal of inflation, and that's what we have been seeing is a steepening yield curve, right? Actually, we didn't see that. We didn't see that yet. We saw that last year, so that's kind of confusing. A flat is uncertainty, inverted. So we're in an inverted yield curve right here, and everybody's expecting recession because it's inverted, right? It's inverted. It's falling. Here it is. Boom. This is what we're looking at, and the reason for that is short-term rates determine the borrowing cost for the economy, right? If you're doing payrolls on a monthly basis, Every company, Walmart, whoever, Amazon, they borrow money, right? They borrow money, or they buy treasuries and take the yield from there. They borrow money in order to do payrolls. They borrow money for short-term projects, for short-term investing, whatever it is. So if the cost goes up on them, then sort of, infrastructure builds, that gets more expensive. Therefore, you turn off demand. Therefore, economic growth slows. If these drop like a rock and we start inverting back up, if these drop, then the economy is going to be very confident. Oh shoot, okay, we can build faster, right? We can borrow more money. So that's kind of how that works, right? Now the two scenarios, right? There's a couple scenarios. So anyways, yeah, I just wanted to point that out there. If you want to go read that, the mechanics of the yield curve, I got that all written down, right? Blah blah blah. That's just more educational. Maybe it'll help you out, right? I wrote it about a year ago. Maybe give me a star on there. Give me a like if you like it. Comment on it. And that's me promoting my write. It's free, by the way. Just go check it out at mindgrowth.io. Link in the description. You can find on there. Just type in yield curve. So there's two scenarios that the market actually goes positive or negative, okay? The first scenario that is negative would be that all bonds on the short term, right, and on the long term, because what we're looking for is the yield curve. We're looking for this to come down and for the long end to go up. That's the re-steepening of the yield curve. Right now it's inverted. We want it to steepen. We want the long to go up, and we want the short end to come down. That's a normal economy, right? Right now we're in a recession. So we're looking at a recessionary yield curve. But there's two ways that this could play out. Oh my God, dude, I'm tired of these ads, right? So the bad way, the negative way is that what we see is the long end of the yield curve, which we are kind of seeing, just starts to lift. This doesn't move. The short end doesn't move. The short end sticks at 5%, and the long end starts to move up. So if the long end moves up, right, looking at when we're kind of seeing that right now. Look at 30-year mortgages, right? I'm sorry, 30-year rates moving up very fast. Okay, 30-year rates are moving up very fast. So if 30-year rates break out, 10-year break out, they keep going up. Well, the 2-year, it's kind of flat. But if you get the long end of the curve, 10, 30 years moving up, basically you get you get the short end of the bond market and the long end collateral falling. You don't want that. You get all the collateral falling, meaning interest rates explode on the long end and on the short end. If that's the case, the market's going down much further. The market is not going to like that because all rates are higher. Okay, the positive would be that these 10-year or these long end rates, and you could call the mid range is like 3 to 10 years, maybe 3 to 7. Long is considered 10 to 30. Short is considered 1 month to 6 or 1 year, whatever, right? So the positive would be that these long end rates just stay where they're at, maybe at 4.6%, 4 and a quarter, whatever, and you get the short end just drop like a rock. That would be the positive, because then if it drops like a rock, then you do have that expansion, right? Or you have the yield curve start to normalize. It comes down, it's a normal yield curve as long as it gets below here. So you want short-term yields to drop below 4% where the long end is at, right? And then you get a normal yield curve, right? That's the positive end. But in order for that to happen, you need a lot of bids or a lot of buyers to come jump in and buy these yields, right? And they are pretty attractive, right? 1 month, 5.5%, you're going to yield 5.5% at 2 months, 3 months, 5. So you're getting yield every 3 months. That's a lot of good yield, right? So it is attractive, but people are uncertain about the economy around it. They're uncertain about the U.S. Treasury. Are they going to default? What's going to happen? So it all comes down to the Feds. This comes all the way back to the Fed. What is the Fed going to do, right? Are they going to cut rates? If the Fed does signal they're going to cut their rates, which is 24 hours, like this is the 1 month rate. If they signal they're going to cut rates, and the Fed's pretty much at 5, right? If you notice, the Fed's at 5.5, it's the same. If they cut rates, these yields come down. We start to normalize. People are confident to buy these yields. They come down, we start to normalize. So that's why the Fed's signal about cutting rates is so important, is we want a normal yield curve so that the economy can now, it's cheaper to grow the economy. Right now it's expensive to grow the economy, right? It's very expensive to grow the economy, and we want that to go cheaper. We want these to come down so it's cheaper to grow the economy, which means you borrow. Your borrowing rate is not at 5.5%; it's shorter. Now, here's why the yield curve might not matter at all. Okay, here's why it might not matter at all, because to the stock market, anyways, not to the economy. Here's why it might not matter at all, because what you're really seeing is at the 1-year rate, this is where money market funds, you guys have heard the whole adage that money market funds are at an all-time high, $5.5 trillion of money market funds liquidity. Well, the reason people are doing that is because they're getting paid. If you go on Robinhood, you're getting paid 4.5% interest to hold cash, right? So what's happening is the money market funds are parking their cash, and this is really confusing, so let me simplify it. This 1-year rate, 5.36%, right? This is basically how much you're getting on cash. You're getting 5.3% on cash. It's probably lower than that because whoever's lending you, whoever's paying you is going to collect. They're basically owning the US Treasury at 5.36, right? And then they're going to collect 80 basis points, and then they're going to say, hey, you want to collect 4.5% cash like Robinhood? And so you get 4.5% cash while they get 80 basis points off of you. So they earn off you plus whatever they're not lending out, they're still going to get 5.5% at the 1 year. Now, what that does is it gives you more liquidity in the market for owning cash, which is another reason probably the dollar is going up, because the dollar is valuable. If you own dollars, if you own US dollars, you're collecting 5% on your cash, somewhere between 4.5% to 5% on your cash. So that's why I'm like, well, you know, maybe it doesn't matter. Maybe people are actually just saying, hey, our big investors saying, let's just hold cash because we're going to yield that cash. We're going to yield off that cash, and then we can reinvest it when the stock market drops, or we can just spend it into the economy, or we can buy more cash and yield more. So there's a lot of cash on the sideline, right? That's also what that means. So that's kind of my take on the yield curve. The real risk is that this the long end of the yield curve starts to really re-steepen higher. Okay, we don't want that to happen. We want short-term rates to drop. We want buyers to come in and start buying these 1 month, 2 month, 3. Now there are buyers actually here. Who are those buyers? And this is why I'm also optimistic about the economy. Let's go. These are 10-year rates, right? We're looking at the 10-year. Let's go to 2-year. Okay, we're going to 2-year rates. There are actual buyers coming into the market, and guess who it is? Money market fund liquidity, and this is why I'm looking at this. These are people who are collecting that. Remember, we said the 1 year is collecting 5.3%. Well, people are collecting that 5.3%, but they're now leaving. They're leaving, and them leaving is a reflection of this going higher. And this is the money market funds. Hopefully I don't lose it, everybody here. This is money market fund liquidity that is leaving the Fed, right? It's leaving the Fed. It's saying, well, you might be giving us 5.3%, but we see something more attractive. What could be more attractive than getting 5.3% at 1 year? Right? Where's that 1 year at? Here we go. 1 year. What's more attractive than that? Well, how about I just collect 5.56% in 3 months? That's way more attractive, right? In a third of the time, I'm going to get a higher yield. So that liquidity is leaving, right? Leaving the Fed, and it's going to buy those treasuries, which is why I'm hoping, or I'm thinking, you know what? Short-term rates should come down, because the more attractive those short-term rates are, right? The more attractive these are, the more buyers come in. And the lower the rates come, the more economy can go up. So I know it's a bunch of blah, blah, blah. For the most part, the question is who's going to come in and buy these yields. And that's why I'm watching this money market fund liquidity. And if you do match it with the S&P 500, they're almost 1 for 1, right? The S&P wants to see this happen. The S&P wants to see this liquidity step into the market. You can see how they're pretty correlated. As this liquidity leaves, it's basically saying, okay, we'll buy those rates. We'll provide more liquidity into the capital markets, and the S&P has been bidding higher. Has the S&P peaked right around the money market fund liquidity peak, okay? Or the drain stopped happening. So the S&P peaked then. I probably lost everybody with that. So anyways, we're keeping track of this too. We're keeping track of global liquidity. What else do we have? What is the information that just came out? Hamilton just joined. Summary of the echo. So summary of the minutes. Nothing really changed, right? The summary of the minutes I'm going to release if there is something different. I don't think there's much change on the minutes, right? Here's why GDP is going up. It's all government spending. So if you're wondering why GDP is going up, it's literally Joe Biden's spending, and I think he's going to keep doing it. I think he's going to keep. Oh no, I have this wrong. I'm sorry. It's not government spending. Government spending is in green. Totally wrong here. But even though he is spending, don't get me wrong, he is spending. He is creating more bills. I think that keeps driving GDP higher. But the net of it is consumer spending. I'm sorry, consumers are spending. So we see consumer spending. That's a reflection of the data, which we didn't even go over yet. Where's our economic data at? So consumer spending is driving the economy. This is really good. This is really positive right now. And we got that signal yesterday from retail sales. Okay, retail sales doubled. Remember we talked, if you were here with us yesterday, this week. If you were here with us yesterday, we saw US retail sales year over year. I want to say the year over year numbers, right, started to move back up. The expectation, can we see here? The expectation was at 1.6%. I'm sorry, that was previous. Expectation was 1.5%. Okay. Last month it was 1.6. So we were supposed to be flat and we came in at 3.2, right? We came in at 3.2, which matches perfectly with the fact that consumer spending, dark blue, is leading growth. It is leading economic growth. So all these recessionary calls, there's no data to support that. There's no data to support that, right? It's just not happening. And again, the way the market, I think, starts to recover. Yeah, it looks like we're headed back to 438 right now. We're at 440. So S&P headed back to 438. The real risk, hey, dollar. Oh my gosh. Okay, the dollar is bidding up. So this is going to be risk off, but we are hitting the trend. Hopefully we get rejected at that trend, right? We've been getting some rejection. So this is a headwind for the market. US dollar bidding up. Is Treasuries going back up? Yep. Bond yield. So this collateral's falling further, or we can invert it. And this is all the focus right now, guys. This is all the focus is. Let's invert the scale so it makes more sense in your head. All the focus is the government or the collateral for the bond market that sets all prices is falling, right? It's back down to where it was October of 2022. That was the bottom of inflation, right? Inflation bottomed here and collateral was falling here. But once inflation bottomed, there was more confidence. Okay, inflation's done. There's more confidence. And this was off of a really good CPI print. So we got a good CPI print and there were buyers in the treasury market. They came back in, right? Now we're right back to those levels, but CPI is much lower. Back here, CPI was at like 7. Now we're at 3, but the collateral is still falling. Okay. And the difference here is we're headed into recession. So people bought US treasuries for protection. Here, there is no recession. We're actually going to grow. So is this bad? Yes, it is bad for banks, but it also reflects a better economy and it also reflects more confidence in stocks. And so as long as I think we get another good CPI print, we should get another CPI print if oil continues to move lower. So keep in mind, oil moving lower, big positive there. Did I miss anybody's comments there? No, I don't think I did. Tesla found that 226. Yep, you were right. Carbides, I actually thought about that today. I'm looking. I think this is an overreaction right now. Even though the dollar is moving up, the dollar is hitting that uptrend. I'm sorry, the downtrend support at the moment. Tesla's at 226. Tesla's falling sharply. To me, I am looking to buy another contract for Tesla. 2021, looking 5 months out on this bounce. China's stimulating, they're cutting rates. That's going to help Tesla. The Fed's probably more likely going to pause as long as oil's coming down. GDP is revised up. A lot of good positives for that. A lot of good reasons for Tesla to bounce here around 221. It could be the end of the day. Who knows, right? So those are all of our risks at the moment. Let's see if we miss anything. Those are all of our risks at the moment. That's kind of what we're looking at in the bond market. And Powell has a choice. Are we gonna let this U.S. Treasury collateral continue to fall? Are we gonna do something about it? All right, what are we gonna do? I'm gonna throw it on the trading chart, on the other chart. Here we go. Let's get onto this chart, and let's go to. Look at the changes here. Look at the changes. At the beginning of this stream, we were like, okay, we're tracking the dollar. Dollar initially moves up, falls, and then rips higher for new highs. TNX bond yields, collaterals falling, yields going higher. Now you see equal weight dumping like crazy. Now you see advanced decline starting to dump. You see the Qs could not get above VWAP. Institutions sold that. This is right here. This is why VWAP's important. Institutions sold that upside move on the S&P. They sold it, right? Or the Qs. They sold it on the Qs. They sold it on the S&P. We're down to 440. Excuse me. So they're selling that move. The question is, where is the next support level for the S&P? Where's the next support? Let's go SPY. Weekly chart. I think we are dropping. Are we still holding the last quarter of earnings? We're testing it now. 438 next support level, right? Carbides, is that what you got? 438 for the S&P. Tesla, I got 221 if it can't hold here. Let's see. I appreciate you guys if you did subscribe. Thanks, Frank. Thanks for the support. So yeah, that's the yield curve right now. The yield curve is pretty negative. What are we in? We're in hour and 12. That was a big rant. That was a long rant about the FOMC minutes. Look, there's one thing I do want to point out here too, which is that there's definitely a scenario where the Fed actually, maybe I should find the video where the Fed actually cuts rates, right? The Fed actually cuts rates before inflation hits 2%. So this may be the next catalyst here. Okay, this may be the next catalyst here. What are we looking for? We're looking for intraday price action. Actually, let's look at Zoom. They still haven't came in with earnings. Man, Zoom is getting killed, starting to drop that trend. Still waiting for earnings, see how earnings go. So Zoom looks pretty negative. Open Doors pulling back. Any positives today? Is energy moving up? I'm gonna have to look on the other chart to see if energy is moving up. Right now, SPY selling off into the close pretty tightly. Buying opportunity for, what's Apple looking like? Apple pulling back into support. Okay, it's moving back into that second quarter of earnings. It looks like tech stocks are moving back. Check this out. So if we look at Tesla, right? It is pulling back into, this could be support too, also Carbides or whoever else is on there. 215, which was the previous support here, right? 215 could be that next level, which is the last 2 quarter of earning moving average, right? So it's the average price from the last 2 quarters of earnings. We could be pulling back into that level, right? I see that on Tesla. I see that on Apple. Same thing. If you can see it up there, that's that cream colored moving average, right? Microsoft. Yep, Microsoft too. All right, we see that on Microsoft. Let's go Netflix. Do we see it on Netflix? Netflix has a ways to go there. Google. Oh, man, no, Google's strong. Google's above the first quarter of earnings. Amazon's also strong, a little stronger. Nvidia, how's Nvidia reacting? Nvidia's still really strong. That's insane. Nvidia doesn't really care about these. They have earnings coming up too, so that's a big catalyst. Nvidia, Meta's just pulling into the last quarter of earning moving average, so Meta's still stronger than a lot of other companies. Is Palantir pulling back again? 15, first quarter of earnings for Palantir. Caterpillars move over to Dow. See, the Dow, I think the Dow is going to actually pull back here, and then we're going to see tech start to take over. I know I'm a little more optimistic, but I see the setup. As long as oil keeps getting rejected, really good setup for CPI. Really, really good setup for CPI. That's what it's going to come down to. So as long as oil keeps moving lower, really good setup for CPI. And the dollar moving up is going to crush oil even further. Maybe we have some global geopolitical risks from Japan, from China, cutting rates. That might move the dollar higher also. So a lot of things to think about here. But oil, okay, that's the risk to the market. The biggest catalyst is still either worse or better than expected inflation. So oil coming down is a good thing. DE, Boeing. See, these are all pretty heightened. These are industrials. Who else do we have? Lockheed Martin, LMT. Lockheed Martin is disgusting. I didn't realize it was that bad. Okay, so industrials are, what is it, XLI? XLI. Industrials are still kind of holding the highs, though. Industrials are still pretty strong. XLE has been on a grind higher. Maybe it'll slow a bit. Here's XLE, energy sector. XLV, I want to see how biotech is holding up a bit. Healthcare is holding up a bit. So this is the healthcare ETF as a proxy for like Teladoc or whatever. Even though Teladoc's a little more on the risky side, it's not UNH. UNH is one of those Dow companies too, big mega cap, biggest healthcare company in the world. I believe so. I'm pretty sure. So UNH is still it's holding on there. It's above most of those moving averages, quarterly moving averages. Visa still grinding higher. So there's still some market breadth. There's not a big red day. Not all stocks are falling. Okay, not all stocks are falling. This is not terrible. What else do we got here? Yeah, SPY is looking nasty. But this could be bottoming out for S&P. Let's do a little deeper analysis here. Right? Ooh, that looks bad on my screen now. Now it looks like we're really dropping, right? Next support, 438. No, 438. So I'm gonna have to move this. Can I move it? Just man, I wish TOS would allow me to move things. Actually, I think I can if I take the finger. Yeah, I can. Okay. So let's go 438. That's our next support. 438-ish. All right, that's where we're headed for now. I'll extend this. Extend to the extend to the right. Extend to the right. Right, we dropped that level. So now we're pulling in for SPY to 438 and then duplicate the drawing and then bring it down. Our last level is 431. That's when we really had that FOMO. 431 was back at the real FOMO. Yeah, let's actually move this here. There we go. So we have some levels. There's some levels for S&P to fall into, right? Oh, I didn't know I could move it. That's cool. Okay. Still learning new stuff. Cool. So yeah, we're pulling into that level. We dropped the 444. So here we go, S2. We're heading into S2. I have to throw that out there on Twitter. We are headed into S2. This is S2. We also have S3. Fed FOMC minutes are done. Make sure we didn't miss anything else coming in here. I still think the inflation stuff is not too bad. I've back tested the price time projection and it works very well. I used WD Gone strategies. August 16th is a top bottom. I think today is the end. Okay, Carbides, appreciate it. Thanks for the input, bro. If you have a YouTube, bro, go jump on the YouTube and subscribe to YouTube for me. And I have the charts up on there so I can get your input on there in the comments. Because how do I say this? The TikTok doesn't really save any comments. If I get a good technical analysis from you and you're commenting on the YouTube, I can literally look back on it and see what you said. I know that's a lot of work for you, but I'd appreciate it if you could. So I like that. I'm still looking at Tesla. The deeper the S&P goes into the close, the more likely I am to actually buy that call on Tesla to add, especially because Carbides just gave me a signal. All right, so back to Twitter. I'm going to read some of these. We already kind of went over like the technicals. We're looking for S&P to pull in to that level. I think the Q's weaker or stronger? Actually, let's double check this. The Q's a little weaker. Are they a little stronger here? Yeah, the Q's look like they're going to pull into 357 is where I have 357.50. I remember breaking above that level and then holding it back here. This is where we broke that level and then we hold it. So we held it. So 350, and the RSI is coming back down to oversold territory. I think the buyers step in, a lot of cash on the sideline. Just comes down to if the yields are going to peak out there, right? Or the yield's going to finally peak out, and CPI. So right now, the two biggest factors to the stock market, not necessarily the economy. The economy is fine right now. There's no risks to the economy. There is just not any risk. The risks are to the market because the market moves off expectations of earnings. And if yields keep going higher, that cuts your valuations, that cuts your earnings and your margins, right? But then again, you could have GDP actually pump margin. So who knows? It'll be a stock picker's market. But the big risk is basically that bonds keep falling. You get, collateral falling, and you have, what is that other risk? Oil goes back up, and CPI gets hot again, right? Or stays sticky. But right now, at least day to day, 3 days ago, oil was back up, right? But right now, oil is down, and I hope it keeps falling. I actually don't mind if the dollar keeps breaking out to really crush oil expectations. I want those oil expectations to drop, and I think that's better. I think it's better the dollar goes up than actually oil for the long term, because if oil drops, CPI is lower. Here comes the cash on the sideline, and a bid right back into the market. Here goes more expectation for Powell to pause, hold the pause, and get more dovish in his language, and possibly even cut, right? So my prediction now is that if oil continues on this trend lower, if it moves sideways, if we get crude oil, so I'm gonna throw crude oil up here, right? If we get crude oil moving sideways over the next, over the next month, if we get sideways action, so let's highlight this. This is the month we're looking for. We're looking for the month of August, starting here. Okay, this is the month of August all the way out to September. So this is the box we're looking at, right? If we get crude just move sideways in this box, I think CPI comes in at around 3% again, possibly even 2.9, right? 3% or 2.9. If oil goes all the way to the bottom of the range to 75, I think we hit 2.7. I think we get near to 2.5%. Oh my gosh, no way. Yes, I think so. I think we get down to the twos. But you really need oil again to fall significantly. That's my prediction at the moment. Everything else is just noise. Oh, actually, no, I want to keep that there. My bad. Let's keep that there. Let's see if we have any other reports. So GDP's up. Oh, recession expectations for the global economy are fading. Yep. So fund managers, Bank of America fund manager survey, investors saying a global recession is unlikely in the next 12 months. Yep. Growth expectations have troughed and are rising. So yeah, the economy is very strong. There's nothing changing there. Tesla will, Tesla will triple. It's funny. There's a what do you call these things on Twitter? Twitter Spaces where they speak. There's this, if you're a Tesla fan, there's a really good Twitter space called Tesla, or TSLA, will triple in 2022. Really pulls people in there, but they do talk a lot about what's happening with Tesla and everything. See, Bespoke. Does Bespoke have anything? 10-year U.S. Treasury yield. Yep, we know that. USD CNI right now. China is hurting. Their currency is falling. Historically, August has usually been the lousiest in the years when S&P 500 was up 10%. So seasonally, this is a lackluster month, which is why I still think it's a buying opportunity. Very lackluster. Speak louder. Is it not loud enough? Is it pretty low? What up, underground economist? Well, that's weird. I thought it was pretty loud. Guess not. Okay, what else do we got here? Bespoke. The weakest component of home builder sentiment has been traffic. Industrial sector coming in the 50-day moving average. Industrials have been leading lately. What is this chart of? And I'm going to throw all the charts I think make sense. Hey, Ray Dalio said he'd rather own Bitcoin than U.S. Treasuries. Doesn't that speak to the fact that the collateral, the U.S. Treasuries, are getting sold off right now? All right, see that. All right, I'm going to try to see if I find anything that just was inconsistent about the FOMC minutes, any positives, negatives. Maybe the highlights from Zero Hedge here. The highlights, I'm going to go through Zero Hedges, and then I'll switch this up so we can see what we're looking at for S&P. Man, those I love to see oil just collapse. I love to see oil collapse. That's what I want to hear. That's what I want to see. Okay, let's go SPY, obviously. Actually, you know what I'm going to do? I'm going to go Tesla. Where's that buying opportunity, right? Tesla just hit 226. So here we go, Tesla. And I'm going to switch this over to the trader format. This is the 1 minute chart. We want to see like the 5. Let's look at the 5. All right, so we're looking at Tesla as I go through some of these FOMC minutes. Expectations from Zero Hedge. Oh, you know what I forgot to mention? Ooh, the target rate for, let's reset this. So 88.5%. Let's see if this changed. I'm looking at what the market is pricing in the next Fed meeting. Okay, it went up a little bit. So after that FOMC, so this is key right here. After the FOMC minutes, what up, Carbides? Welcome to the chat. After the FOMC minutes, the market is actually pricing in a higher chance of a pause in September. Okay, and it's because of the banking stress right now, because the U.S. Treasuries are getting sold out. So ironically, U.S. Treasuries going up is actually causing more positivity because it gives the Fed a chance to pause with GDP going up. It's a really tricky situation. This is why it comes down to, what do you think? What are your expectations, right? The bears will say a lot of risk. The banks are going to fall apart. The market's going to fall apart. Valuations are too high. That's literally all their argument. I'm speaking pretty loud. Let me see. Tell me if it goes up or skips. I'm going to turn up my audio a little bit on the on my focus on my my microphone. Tell me how that works. So that's what the bears say, that valuations are too high and the Fed is going to keep hiking and break something, and then we go into a recession. But listen, recession's off the table. Consumers are spending, right? Recession's really off the table at this point. And if something breaks, I've said this all year, if something does break, the Fed steps in, okay? Inflation is still on a downward path, and as long as oil keeps falling, commodities keep falling, inflation's going lower, right? Shelter is literally lagging by 12 months. When shelter does come into the CPI, rent's already real-time falling, but when shelter does come in, boom, there goes CPI to 2%, like literally to 2%. The Fed cuts rates. So the bears, they're hoping for a black swan. Okay, that's literally, I think we're hoping for a black swan. We didn't even go over housing market data. We'll go over housing market data before we close it out. Again, this will all be in the weekly macro report, all these charts. Looks like Europe is actually recovering in growth. Actually, that's good. It's positive. Building permits for the U.S. They kind of slowed a bit. Housing starts slowed over the last month, and they picked back up. So housing starts are still kind of up there month over month. Housing starts positive this month. Industrial production for the U.S. Oh, it's not more negative. We talked about this yesterday. Industrial production is recovering. Man, the economy is looking like it's really starting to launch here. The economy looks like it's really starting to launch here because you're getting onshoring. So you're getting manufacturing, but you're getting a bunch of jobs from that we used to outsource to other countries into the U.S. It's called onshoring. More fiscal infrastructure bill, CHIPS Act, Inflation Reduction Act. We're getting all the fiscal policy in the manufacturing sector, and we're getting consumers spending. Possibly they own a lot of dividends. Maybe they're retiring, and they're just spending in the services economy, right? Because they're getting asset earnings from holding cash. They're getting, look how confident people are. Let's say they have $1 million and they're just yielding off that $1 million of cash. You know how confident that it gives people? They're confident. Eventually, they're going to want to buy stocks when they see inflation fall. So that setup is still there. Now, the professional fund managers, they're going to be more tactical. I think they're going to be a little more tactical. They're always a little more tactical. That's the last shoe to drop. No, we got through the FOMC minutes. So yeah, the housing market slowed on its recovery, but it's still there. It slowed a little bit. It's just, it is where it is. We also had yesterday, UK PPI is negative. Wow, UK PPI is negative. So inflation's coming down in the Euro area. They did hike rates. It is coming down. Like we've been saying, this macro cycle is turning up. This macro cycle is starting to turn up here. And then what am I missing here? I was gonna look at something. Oh, that's right. Okay, the zero hedges interpretation of the Fed meeting, the minutes. What changed in the minutes? Anything that changed in the minutes? All right, so we'll get to that. Hey, thanks for jumping on the YouTube. So Carbide says, let's throw this out here. I predict an irrationally exuberant rally coming soon where every bear will capitulate. Okay, yeah, because it's, I call that wave 2 FOMO, right? Pretty much all the risks are starting to disappear, right? Now they're pointing at valuations like they ever mattered in a recovery. What do I think about Tesla, George? I think Tesla's set. Honestly, I think this is a buying opportunity for Tesla. Beneath 235 and 241, there's a lot of positive catalyst. Margins are bottoming for Tesla. They could be announcing over the next 2 or 3 months who's trying to use their full self-driving service when it comes online. Could be FUD, could just be Elon getting overly excited as usual. But that's one thing, right? You also have the revenue from the energy storage. You also have the increase in China production. Right now, I saw there's so much news on Tesla, I can't cover it. There's specialists, but I do see it and I'm like, whoa, okay, that's bullish, that's bullish, that's bullish. So price is just retracing back, right? And we'll look at the price before we get through these minutes. Tesla's a buy between 230, and it depends how you're trading. If you're trying to own Tesla, heck yeah, right? If you're trying to own Tesla for the next 5 years, this is definitely a buy. If you're trading it, you got to be a little more tactical. Where's the support at? The quarterly moving average on the weekly chart support is at 217, 218. There's some support at 221. This could be the bottom, so we'll see. So anyways, yeah, that's my thoughts on Tesla. A lot of good coming into Tesla. Plus we should have deliveries, August, September. I think deliveries in September. I think the overall market may be bottoming here, but Tesla, I still think long-term best. I think they're going to surpass Nvidia eventually. I'm very bullish on Tesla. All right, so here's zero hedges anticipation. Okay, and this is all keeping in mind that GDP just got revised up to 5.8%. A couple months ago, it was literally at 1.4%. It just keeps going higher and higher. Consumers are spending a lot of cash in the system. Participants noted that a gradual slowdown in economic activity nevertheless appeared to be progress consistent with a restraint placed demand cumulative, blah, 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 blah. Basically, they said that they are slowing down demand. I don't see that. Participants continue to view a period of below trend growth in real GDP as some softening in the labor market. Not happening. This is weird, man. A lot of stuff is just not matching up. It's not very consistent. This is why we look at price on Tesla right now, and that talk rise down also. Yes, it is a lot of bad news on Tesla right now, and the talk rise down also. I'm not sure what you meant there, but hey, when there's a lot of bad news in Tesla, that's when you want to buy. When price is just getting destroyed and you get that RSI oversold signal, that's when it's time to buy Tesla. It's going up. It's going back up, especially when the market recovers. Price is down. Oh, okay, price is down. Yeah, they did cut a little bit of prices, a little bit of their prices over in China, but look, China just also cut their rates, and they're going to keep cutting rates, so that helps. And number two, it was only like 8% of volume, so they're not really doing price cuts all around the board. They're just doing price cuts a couple ways. They're going to gain more market share, and then they can increase prices again when rates drop, maybe in 2024. Okay, so while the overall banking system retained ample loss-bearing capacity, some banks experienced sizable declines in fair value of their assets. We already read that, which basically means that the Fed is aware, and this gives reason to pause. The Fed is aware that, you know, the banking sector is at risk here. Since the emergence of stress in the banking sector in mid-March, indicators of spending and real activity had come in stronger than anticipated. Yep. As a result, no staff no longer judge the economy to be in recession. Nothing really changed here. All right. We get the FOMC minutes, and it's just really giving us more very confidence that the Fed sees what we're seeing. Hopefully they keep an eye though on the, hopefully they do keep an eye over there on the Treasury market, which keeps on falling. The Treasury market collateral keeps falling. I think that's the only negative story here. Who's going to intervene? Who's going to buy here? There goes Tesla, new low of day, 226. There's your buying opportunity. Thanks for commenting on there. Got to get those comments up. So we are looking good here. Oh, wow. 226. Okay, and we're 145 in. This is a long stream. Went over the FOMC minutes to see what else are we missing here. All right, so Tesla technicals. I think we'll close out with this. I think I covered everything, right? I think we covered everything, right? It's really, hey, the Fed needs to keep their eye on those rates. Or on the 30-year Treasury. Are they going to step in? What's going to happen? Yeah, I think we covered it. We'll see. I'll double check to see if there's a new story on CNBC that we missed. Tom Lee talked about the S&P. That was this morning, though. I want to hear what he says afterwards. Oh, is this morning, or is this oh, this is afterwards, huh? What date was this? Oh, this was an hour ago. No way.
Good afternoon and welcome to this afternoon's edition of CNBC Pro Talks. I'm Dominic Chu. The first half of 2023 went off and started with a bang. The market rallied tremendously, driven by half of 20.
Okay, I'm going to keep this story up. Maybe I'll edit it if it's pretty good. It's Tom Lee and Stephanie Link. She's very bullish on the economy. He's bullish on CPI. So I think this is a setup for a buying opportunity. We're going to switch to Tesla technicals, right? Tesla technicals. And then we're going to be done with this stream really quick here. So first, look at the 4-hour chart. Extremely oversold, right? We are oversold. We're at 20 on the 4-hour chart. We're at 21. Last time we hit 21 was in, this was, what was this, April? This was the end of April going into May. We hit 21. And I mean, we kept declining at 21. This was after earnings also. So that was more sharp. That was a sharp move after earnings. And then we bottomed shortly after that. As the RSI recovered, we bounced back. And then the last time we got to 21, before that, or a little before that, these are usually bottoms. Tesla should be bottoming over the next week or two. I'd say the next week, honestly. It could be bottom today. Yeah, these were all the marks of a bottom on the 4-hour chart here, right? You got that. You got the bottoming here, here, here. I mean, it wasn't the exact bottom, but it pretty much bottomed after here. And this was after earnings, so this is why this is good, because we already had the oversold, right? We had the oversold, and then now we're going oversold again following earnings. This is a very sharp decline. 25% on average was the decline for Tesla stock. So let's take the pull down, right? 24.5%. Great. How about here from this high? 20, 25, 26%. Okay. And now we're at, and this is for the upcycle that we've been in, and now we are currently at 24.6. So 25% will be about 221. I think if we don't bottom here, 221 is about the bottom, right? And we don't know that for sure. This is if the S&P finds its legs at some point. 221 is the bottom. Go to the daily chart. What are we looking at on the daily chart? We are looking at, obviously we got to put the moving averages on. Let's go macro. We're headed into that 100 daily moving average, which is around 221, 220. Okay, so maybe pre-market we feel, oh, this is also a gap. Oh, 221 was the gap. So I think the hard stop for Tesla here, 221 bounce before it goes any lower. I think 221 is going to be the low. I'm going to call that out right now. 221. Okay, if I'm wrong, trash me tomorrow, whatever. Maybe we go 221 and touch it in pre-market tomorrow, and then we start bouncing. So I think 221. That's what I'm going to stick with, 221 for Tesla. Especially this wedge is breaking to the downside. That's extreme. We didn't even go over crypto either. And the weekly looks a little different. Okay, 50-day. Okay. Well, I think that's all she wrote. Any questions, any comments? I actually day traded Tesla today. I went for a call at open. I'm carefully watching 226. The next support for me is 220. Okay, nice, Carbides. I'm day trading it. Yeah, day trading is a tough job. Shout out to you. That's tough, man. Day trading is hard. You really got to be focused when you're day trading. Hey, thanks for jumping on here too. I like to see the comments. Now we hopefully we get a little more engagement on here on the YouTube chat. Right, YouTube is tough to grow, but I want to be able to sustainably do this, you know, on a weekly basis consistently. Where TikTok doesn't really make much sense, but if I can do it on YouTube, then you know, I'll be here for a while. Tesla will go down to 180, 200 before it goes up. Oh, you think Tesla goes to 180 to 200? I don't. Are you asking me? Only if the only way Tesla goes down to 180, right, where there's a heavy support at 180. I just don't see it happening unless we see the overall market. So let me show you the overall market. Unless we get, and I'm going to go with QQQ here. Unless we get the Qs pull back to, I mean, I guess this could happen. Maybe 346 or where was that previous breakout? I know I took it off. 334. Yeah. The only way I see that happening is if Tesla pulls all the way back to I'm sorry, not Tesla. If the Qs pull all the way back to like 334, 335, which was previous support for the Qs, that's the only way I see Tesla trade all the way to 200. If we see the Qs really, really start to break down, which means the SPY has to also break down. And this is they're all connected, which means the SPY also has to break down all the way down to about probably 420. We'd have to come all the way back to the 420 level for S&P for that to really play out. That's what I think. Maybe I'm wrong. That's what I think. When stock breaks out to the upside, okay, let's see. When a stock breaks out to the upside of a falling wedge pattern, it is extremely aggressive, right? Yep. 100%. Now we are breaking down on Tesla on a downwards trajectory, but the trend is up. So I would say this, I would add this, Carbides. I would add that when a stock breaks up from a wedge, it's extremely bullish if or when also when the trend is higher, right? When the overall trend is up. So we are getting the opposite, which you would say, you would think, oh, if we're breaking down from a wedge, this is the wedge. If we're breaking down from the wedge, this should be extremely bearish. But in my experience with Tesla, when you're in an uptrend and you capitulate to the downside, my experience is that was the end. That was the end of it. It breaks down and then the buyers step in because they want to get back in. So that's pretty much my experience. And look, we've had some wedges earlier, so keep your mind on this. I don't know if anybody's really pointing this out, but not clear draw set, just remove that drawing. So really quick, look at this. Ooh, no, that's not the tool I want. Okay, we've had these wedges happen already. These very sharp wedges. Actually, let me pull back. Kind of looks a little suspicious. There we go. See if I could draw the wedge. I would say this is kind of the wedge that we saw before for Tesla, wedge there. And then you could call this a wedge where it kind of broke down also. Now that was a big gap down. So you had a couple wedges already, right? They kind of broke down too. And this is what I was talking about, is that Tesla kind of wedges, and this isn't the perfect wedge, but it breaks down and capitulates, and then boom, buyer step in. Same thing sort of happened here. It broke down in the wedge and the buyer stepped in. And now we're getting the same thing, right? We're breaking down on the wedge. So maybe 221 in pre-market, buyer step in. It's like they say, when the best, oh, I'm sorry, I didn't read your comment. George Chaman, or George. Yes, that's what I think all will go down before we get a really bull market. Okay. Yeah, I just think the CPI is going to help us. Oil, it's really oil. Can oil keep trending lower to get that CPI and very confident CPI? It's like they say, when the best time to buy comes, you will not want to buy. Yep. Yeah, everybody's getting scared, but Tesla has such a community to it. Like, those dudes buy, bro. They have a crazy community, so they buy. What is Bitcoin looking like at the moment? Bitcoin's still consolidating. Man, when that regulation comes through, it's going to be some big upside, I think. ETH, what is ETH looking like? These are futures, by the way. ETH still consolidating. Everybody expecting that move back down to 1,600, possibly. Maybe we do. All right, well, hey, I'm out of here. My back is killing me sitting down. You know, usually I do a stand-up stream, but I'm in a different location, don't have a stand-up desk, and might stay here longer. Might be here a little longer because I am just visiting. I haven't really took a break for a while, but I appreciate you guys jumping on. I'll be sending out some reports later on in the day, maybe edit a video and see what people's thoughts are. Maybe that Tom Lee video, we'll see how it goes. But thanks for jumping on. I appreciate you guys. Okay, make sure you guys, oh, my camera just went out. Dang, just in time. Perfect, camera goes out. So make sure you guys, there we go. Make sure you guys stay healthy today, okay? Get your workout in, sleep good, and stay blessed. As always, stay blessed, and we'll catch you tomorrow on the technicals, the macro, policy, any other data that pops up. Appreciate you guys again, and we will catch you later. Thank you.